Over the course of your life, one single expense will claim more of your wealth than housing, food, or transportation combined. It is a slow, steady extraction of capital from your earnings. Yet, despite the vast amounts of money flowing out of our pockets and into the system, most of us operate on completely false assumptions about how the underlying math actually works. You can see this financial illiteracy in action almost anywhere, particularly in the classic dilemma of an employee debating whether to accept a pay raise. The fear goes like this: if you earn $60,000 and a raise pushes you into a higher 40% tax bracket, the government will suddenly take 40% of everything. In this scenario, earning more money mathematically leaves you with less take-home pay. Believing this shows that we treat the tax code as a blunt, unavoidable penalty. We don't realize it is a highly structured, logical system, and mathematical systems can be legally manipulated. The truth is, almost every modern nation uses what is called a progressive tax system. Looking at this diagram of a progressive system, you can see exactly how it functions. The tax rate only applies to the specific slice of liquid, or income, that falls inside a given layer, not the entire volume. Notice how the foundational layer of your income sits in a 0% zone. The government protects those first $10,000 or so entirely from taxation. As you fill the next layer, you pay a modest 20%. By the time your income reaches that intimidating 40% bracket at the top, the rate only bites into the final few overflow dollars, keeping your total tax bill much smaller than feared. By picturing taxation as vertical layers rather than a flat percentage cut, we expose 3 legal mechanics you can use to intentionally lower the liquid level and push your money out of the government's reach. The first mechanic is shrinking the base. You execute this using recognized retirement accounts, like a pension in the UK or a 401k in the US. For the standard employee, the government extracts its cut the exact millisecond a paycheck is generated, long before you ever see the deposit hit your bank account. By routing a portion of your paycheck into a pension vault, you intercept that money before the government's tax filter. Mathematically, diverting $6,000 from a $60,000 salary shrinks your taxable base to $54,000, dropping you down the progressive tax ladder. Utilizing a pre-tax account functions as a real-time tactic to retroactively lower the mathematical baseline the government is legally allowed to use against you today. The second mechanic, rewriting the sequence, becomes available once you step away from standard employment and look at side hustles or independent businesses. As an individual employee, you are locked into a rigid sequence. You earn money, pay taxes on those earnings immediately, and spend whatever capital remains. Registered businesses operate on an inverted sequence. They earn, spend on operations, and only pay tax on the remainder. Items you already buy, like a laptop or utility bills, become deductible expenses. As these costs accumulate in the spend column, they directly shrink the taxable remainder. Furthermore, the corporate tax rate is entirely divorced from the personal progressive brackets we saw earlier. It often sits at a much lower, flat percentage, such as 19% in the UK. Setting up a formal entity allows you to legally fund your own production first, shifting the burden of taxation to the very end of your financial timeline. The third mechanic is shielding the yield. This relies on post-tax investment platforms, known as an ISA in the UK or a Roth IRA in the US. Because these accounts offer such an immense mathematical advantage, policymakers frequently propose changes to them, requiring you to stay vigilant to current legislation. With these accounts, you do not get a tax deduction on your income today. Instead, you are allowed to place your post-tax capital inside a legally recognized impenetrable barrier. This chart demonstrates the long-term effect of that barrier. Once your money is inside, all the future compound growth, dividends, and capital gains generated along that curve deflect any future tax claims. The profits remain completely invisible to the taxman. So, while pre-tax retirement accounts manipulate the math of your present income, post-tax shields protect the exponential wealth you build for the future. Stepping back, it becomes clear that the global tax code is not a random assortment of penalties. It is a highly deliberate behavioral incentive structure. Governments intentionally build these pathways into the law. They want citizens to fund retirements, build critical infrastructure, and inject capital into financial markets, so they reward you for it. The friction point is that these mechanics vary wildly depending on your exact jurisdiction. Applying them safely requires extreme precision. Because the rules shift so frequently, the most effective move you can make is to hire a localized professional accountant or financial advisor to map out your specific situation. People often avoid this because of the upfront fee, but spending a few $100s on professional guidance results in tens of thousands in legal savings over your lifetime. In the game of taxation, remaining passive guarantees that you pay the maximum possible rate. But once you understand the underlying rules, you transform your single largest expense into a controllable mathematical variable. Hit subscribe and click the bell icon for our next breakdown.